So the Fed has finally started to lower interest rates again, kicking it off this past week with a quarter point cut. And it just so happens that whenever the market is near an all time high, as it is right now, well, 100% of the time, the stock market has soared much higher following the cut over the next 12 months. In other words, based on historical performance that, again, has been 100% accurate every single time, we are very likely in for yet another big market rally, which is pretty crazy to think about considering that many people actually think that we're in a bubble right now that is set to burst. Well, in today's video, I'm going to break all of this down for you and share my own opinion and my own predictions for what I think will happen here going forward and what I plan to do myself and how I'll be taking action as an investor. As always, though, I'll put chapters for you down below in the time bar in case you need to jump around. All I ask in return is that you please consider subscribing to the channel if you haven't already. It really helps keep my channel alive and well. So thank you to everyone for that support. But with that said, let's go ahead and jump straight into this. And let's really start first here with just a quick update on what happened this past week, where the Fed decided to cut rates on Wednesday by 0.25%, so a quarter point cut, in an 11-to-1 vote, with the only dissenting voice actually advocating for an even larger cut of half a percentage point. The reason why the Fed ultimately decided on the smallest cut, though, is because it was really meant to be just kind of the kickoff or starting point for what will be a gradual adjustment over time. In fact, they've already signaled for 2 more cuts coming before the end of this year, which would get us down to well below 4%. And the reason why they're doing it this way is because inflation is still sitting higher than where they'd like it to be, which they typically combat with higher interest rates. However, at the same time, the Fed sees weakness in the economy right now, particularly in job growth, which they're hoping to provide some relief for to both businesses and consumers by slowly lowering interest rates to make borrowing debt a bit cheaper and easier to manage. By the way, our current debt levels are actually my biggest concern. I think if you ask the average consumer out there how they're doing financially, you'll find that most people are really drowning in it. And I'm not saying that lower interest rates is the solution to that, but I'm just making the point that the economy is actually not as strong as you might think it is. In fact, we recently just had a report come out from FICO that showed people's credit ratings have actually seen the largest 2-year drop since the Great Recession. Guys, that's terrible. And I bet that I can tell you exactly why it's happening. It's really because everyone keeps taking on more credit cards and debt, which is lowering their scores. Case in point, credit card debt alone is now sitting at an all-time high of more than $1.2 trillion in America. That's pretty bad. And so the Fed, doing what the Fed does, decided to lower rates as a response. And yet, as terrible as all of this might look macro-wise, not only did the stock market break another new record high this past week, but there's actually very strong reason to believe that it's only going to continue to climb even higher throughout the next year too. And here's why. So this is coming from Carson Research. Since 1980, what many consider to be around the start of modern Fed policy, well, there has been 20 times that the Fed cut rates when the market was 2% or less away from an all-time high with a following year of data. And every single one of those 20 times, 20 out of 20, the stock market proceeded to rally by even more, climbing on average by about 14%, with many cycles delivering gains of more than 20% too. And that's huge, especially on an individual basis. I mean, you're talking about some of the best performing stocks likely skyrocketing in price. And so if you're betting that the market will perform poorly or even flat out crash over the next 12 months, well, you're basically betting against a 100% track record of the complete opposite happening. On top of which, what makes this data even more compelling is that the rate cuts typically happen during mid-cycle slowdowns, which is exactly the situation that we're in right now, where the Fed isn't really cutting because we're in some large crisis, but rather they're cutting in hopes of preventing one, trying to give the economy an extra boost to keep it rising even further, which again, we may be critics of that policy, but it's worked every single time for at least another year. And that's just what, historical data shows us. However, many investors feel that this time will in fact be different. And to their credit, there is actually pretty good reason to be skeptical. For one, the market is very highly stretched on a valuation basis, where the S&P's PE ratio is currently sitting around 80% higher than historical averages. Now, to be fair, we have had higher PEs in more recent history, but it's still a large concern to see so many companies valued so highly, especially tech stocks with high exposure to artificial intelligence, and what many fear is an AI-induced bubble. However, the bulls would argue that it's actually that rise in AI stocks is actually causing much of this rally. Companies like Nvidia, Microsoft, Apple, Palantir, and more. Whereas many other legacy companies that are being maybe perhaps ignored by most investors out there looking for more FOMO are actually trading quite cheap. If you're willing to look out and search for them, which I do actually agree with a bit myself, because I've been buying tons of REITs and giants in pharma and telecom and food and more, where the vast majority of those stocks that I've been buying, they trade for dirt cheap PE ratios and sky high dividends, many of which we haven't even seen at these levels since like the Great Recession. And I put out videos all the time on many great stocks like that, at least in my opinion. Plus, bulls would argue also that while AI is causing many tech stocks to rise in price, much of it is actually justified given how much value AI brings to their businesses, where over time, AI will actually increase efficiency and productivity, making them more valuable. In other words, it's not just based on hype and speculation, but some actual value here that may even improve the lives and work of even the average consumer out there too. On the other hand, though, it's likely to displace a ton of jobs as well when looking at artificial intelligence, which I don't think we'll really grasp the full impact of until it's too late, but I'll let you guys be the judge of all of that for yourselves. And finally, I would also just argue too that historical performance is not always indicative of what's to come, especially given how complex and different really the world economy has become and continues to evolve every single year. For example, something that we're dealing with right now that we haven't really dealt with in a long time is a complete change with our trade policies, namely looking specifically at tariffs under the new Trump administration, which I'm not here to argue are good or bad or get into the politics of all of that. I'm just saying that it's something very different from what we're typically used to. And so historical performance of the stock market may not be the best indicator of what's yet to come. But because of that, here's my personal take on all of this and how I plan to navigate this whole situation myself as an investor. Well, first off, I think it's important to acknowledge that both things can actually be true at the same time, where we may in fact be in somewhat of a stock market bubble, especially at the higher end of that, concentrated greatly in tech, and yet we may still see the market charge even higher over the near to midterm too. In other words, just because some AI stocks might be overvalued right now doesn't mean the entire market is doomed tomorrow. And most importantly, what I always preach and practice myself is that trying to actually time the market based on recession and crashing fears is almost always a losing strategy. In fact, I would argue that pretty much every year since the Great Recession, I've heard countless talking heads, especially in the media, but even regular people all over social media too, screaming from the rooftops about how the stock market is so insanely highly valued and it's about to all collapse. Literally every single year I've heard that same rhetoric. And I'm not saying that it won't eventually come true or has at some times. In fact, we did actually have a couple of big drops or even crashes, you could call it, during the pandemic and kind of post-pandemic years. But the vast majority of the time, the stock market has skyrocketed in price, especially during this period. It's been one of the biggest, bull kind of cycles, you want to call it, during that time, ever since like the Great Recession. And so that's been happening the vast majority of the time where the market has really soared. And again, just this past week, we've already hit yet another all-time high. So it just continues to happen where, anyone that has been staying out of the market because of various fears have really missed extraordinary profits all along the way, all the way up to this point where we sit today. Hence why I only advocate for really investing long term and on solid companies that you extensively research and do your due diligence on. In other words, time in the market will always be a better strategy than timing the market, which in my opinion, is impossible to do. So, in conclusion, do I plan on selling everything today based on fears of everything collapsing or some bubble bursting? No, absolutely not. But am I throwing every dollar I have from all of my savings into the stock market recklessly because I think that the market has to climb with 100% certainty no matter what over this past year? Well, no, I'm not doing that either. I'm sticking to sound long term investing, buying high quality companies that I can afford and that I feel are fairly valued or maybe even undervalued, preferably undervalued, based on the current price and their future potential. But hey, that's just me, guys. I'd love to hear your own thoughts down below. How do you feel about all of this? Share your opinions there. What are you doing in the market? I'd love to hear your strategies and your thoughts. But either way, I hope you enjoyed the video and I will catch you in the next one. Hope you're all doing well, my friends. Take care out there. Bye-bye.